Hello, how are you?
Blog
It is
Talk
10 o'clock
Radio.
a.m. Pacific Standard Time. What we are going to be talking about today is we're going to be talking about the worldwide financial crisis. And how do you protect yourself in a potential financial crisis? What do I mean by that? How the financial system would actually lock itself up in places around the world, such as Europe, such as Asia, but not so much that they would lock up. Asia won't. It will continue to grow at a slower growth rate. However, they're not going to be making as much money. The U.S., same way. The S&P 500 is heavily weighted to Europe, 20% of it. And if growth slows down, as we had forecasted a long time ago, that the banking crisis would come back to haunt America. And it would. And we have live videos from our forecast, even going back to 2009, of what it would look like in a 18, 24, and 30 and 36-month cycle, with the original financial crisis that came in was the worldwide episodes with the domino effect back in 2008. We had forecasted that back in 2004 or 5. Why? Because the way that we have done business around the world has not been the right way. And what do I mean by that? And I try to keep it in very simple terms when I say the right way. And that's exactly what I mean. The stimuluses are only the short-term fix, as we've always said. When it comes to investing, trading, making a market, whether you're institutional, whether you're in the hedge fund manager community, doesn't matter, or you own a big firm, or you're a broker-dealer and you're getting involved in different things, everything has to have a risk management application to it. And this is where the extreme volatility of worldwide debt, there is a collateral system to debts. And basically, assets get marked down in a deleveraging process. And where does that come from, deleveraging process? Well, I can tell you, it doesn't matter what part of the world that you're in, whether U.S. or anywhere else, for that matter, is the consumer payroll society is the key and core existence of any country, city, state, whatever the case may be. The financial part of it is that one of the things that we've always told people is how they inject monetary value in the system. And what is monetary? Wow. And what is monetization or monetizing? And what does that really mean? Look that up in the dictionary. How does that apply to you investing, trading? Doesn't matter what level of investor, buy and hold you may be or not, and or a live floor trader making a market between the public. That's what we do. And we have to know how to read the economic cycle so that we can apply a very well managed plan based on risk management scenarios within a systemic financial crisis, so that you're looking at part A in its entirety, then part B is part B. So you have part A would be a bull case, and part that people do not want to have to deal with is the debt crisis part of it. The debt crisis. Why is it a crisis? It's a crisis because people mismanage the risk. That's what they did. And there wasn't enough accountability within the system. The U.S. banking system is quite different than the European banking system right now and other worldwide banking systems. Today, all of the worldwide leaders have come into play, including the Federal Reserve, and all central bankers are going to come together to make a financial contribution. What do we call it? Let's tarp it up. We all know what the word TARP means. Let's keep it simple. If you don't, go Google it, and you'll find out what it means. And you can ask questions around it. One of the most important things is that there has to be a collateral process to debt. Therefore, if the euro collapses, what happens? We already know what happens. It's a run-over effect, meaning that it travels down the river until it reaches your destination, and it will, and that's the destination of growth in the U.S. and what that markdown in growth would look like, and what would be the pricing of the markets, and what kind of controls would you apply as far as the asset classes. What is the true wholesale market to the debt crisis, to what equities are worth around the world, how to take advantage of a major markdown, and why do we have the liquidity injections in QE3 coming down the road, and there's many more things that play into the bigger picture that we will be discussing. The part of it that I want to make clear is that people understand that volatility works both ways in bear economies and bull economies and vice versa. The core principle of understanding how capitalism is distributed and where it started from and how it travels now around the world and how it exchanges with people. The note holders will have someone come on, and I'll ask people what certain things mean when they ask their questions, and do they understand it. The systemic risk will run over in 2012. The short-term capital injections will meet a requirement in the near term that will actually stop the consumer payroll base in various countries around the world from stampeding the banking system and wanting their resources, their funds, in whatever worldwide currency it may be. Won't matter. Every society, every payroll society in every country, it's the consumer, the payroll society, they're going to be the ones that run and stampede that bank. Yes, they will. Now, the news is the more that I have to inject in the system is if I would look at it in the right term, it would mean one thing. It's worse than anticipated. Or it's worse because the truth was never really revealed until now. This is always a possibility. We would like our viewers and listeners to know the reason why we do what we do is because we're on your side. We're all part of it, no matter what. When it comes to the financial world, it's an ongoing, continuous battle. Because all of the financial crises and all the debt crises that are hitting now, even with the capital infusion, it's only going to last for so long. Not only that, potential inflation going into the lateral part of 2012, let's say right around the August period of 2012, would be starting to be getting very inflationary again. Consumable edibles such as food products, food inflation, such as gasoline, heating, all forms of energy, of course, would be higher for the consumer to pay in a deleveraging pricing control environment. And a deleveraging in assets mean lower standards of living. And when the societies in general have to go to a lower standard of living out of their current comfortability, then you start to have even more problems escalate. And how true that is. If we have any callers that would like to participate, you're welcome to, I will find out and see who's here. Let's take a look. Go ahead and see if there's a caller. Area code 661. Caller, you're on the air.
Is that me?
I guess it would be you. Caller, you're on the air. Your name?
Ken Flagg.
Okay, Ken Flagg. How can I help you?
So if somebody had a 401k or something that wanted to start with you, how would they go about that?
Well, we have a lot of various portfolio risk management services called educational training modules that would help incorporate the right kind of thinking and the right kind of skills as far as dollar cost risk management, stop loss programs, profit programs. So basically it starts with the educational process first. And then people will learn how to be in control. So how do I know what these people are doing? Is it takes some training. And so, yes, to answer your question, you'll be able to get that.
Okay, should we be trying to hold, what should we be trying to hold in our accounts right now? Getting out of what and getting in what?
The thing about it right now in the markets, we have the Dow's up over 400 points. I got the NASDAQ comp today's date, once again, 11/30/2011. The time is, once again, 10:12 a.m. Pacific Standard Time. S&P 500's up 41 handles. Dow's up 416. NASDAQ 100 up 73. And NASDAQ composite up 87.4. How about that? What is that? That's called volatility. Short term, which requires skills and training management in the execution model, is how does one execute with bull and bear instruments, Ken? Okay. Is where you would start with a diversified risk management between both parties, both the upside, the bull, and the downside, the bear. And that would take, a good 30 days of actually being trained live while it's happening in the market on a live trading demo, and with the exits and the entries, and we would be right here with you, just like you're asking me a question now. Is there any other thing?
Sounds pretty good.
Yeah, it is.
Yeah, that's interactive. I like that. Okay. No, that's all, I guess.
Okay. Well, Ken, stay tuned. Have you been following us on YouTube?
Yes, sir.
Okay. How long?
Sure have.
How long?
A couple years.
Couple years. Yeah, we're the #1 out there, it looks like, huh?
The only one that knows what they're talking about. Look for me.
Right. So go ahead and go to info@stockmarketfunding.com. You can tell all of your friends to send their emails there as well, okay?
Thank you.
You're most welcome. Next caller. Is there any other callers?
Yeah, can you hear Gibson?
Mr. Gibson? Yes, I can.
Yeah, I've didn't get in on the gold bug, and I was wondering if there's a future there for gold trade.
Well, the gold trade has ran its major course. Once again, it's going to be about one thing only. When people have gold and it's physically in their hand, and if things were to get very risky moving forward, gold could become the next fever of currency. Why? Because we can barter with it. Or we can buy it in ETFs and other things, and we actually think we own it, but it's not sitting there in our hand now. Okay? That's number one. So what do I think about gold? Gold has made a huge move, and it was a great place to be and still is because of the uncertainties, mainly is what's been the key driver. Whereas before there were lots of other mechanics that went along why with gold would go higher. It's quite different today back versus the older days, the way that it was evaluated. Right now, back in 2008, people could have got in on ETFs such as the GLD. They give great gains, and I think that gold is a place where people feel comfortable, and the supply and demand right now is people are always going to revert to some kind of value that they actually have, that they can barter with. And it replaces currencies. People feel good about owning it. So I think that on the pullbacks within the actual ranges, they're tradable both ways when they're ready to pull back, such as when a good way of owning this is the ETF. When the high was 185 on September 1, and it made a low that month of 154, that was the time to be buying gold on pullbacks. So with the right kind of training management, I believe that gold within certain time frames, time series, is a place to buy on the dips and then sell when it hits certain levels, but also keying in what is the key driver behind it right now. Hey, because everybody's injecting in the financial crisis system, is if they can make people believe that it's going to be truthful and sustainable, well, the gold is going to pull back in the shorter term going forward. Because it's not going to be as much uncertainty in the financial arena around the world. That big bullpen. What do I mean by that? All the central bankers that came together overnight, along with the U.S., and are going to inject money in the system. Now that that's going to happen, and if people believe it, well, then naturally we'll have pullbacks in gold. I believe you buy every dip and then have an exit plan and then have the right kind of training, technical analysis and understanding why they're going to go higher. And I believe that you can do well with it for a number of forward-looking years, and gold itself could hit easily. If things get out of control, you'll see $3,700 an ounce. Well, we have to multiply that by 36-month cycle, though, okay? And it could easily go that way because it would be the masses of people around the world would want to own that, because if they have it, they feel that they really have it psychologically. So, yes. Is there another question I could answer? Does that answer your question?
Yes, it does.
Do you agree with it or not agree with it?
I agree.
Okay,
I've just been trying to figure out how to take advantages of it because I've been a little late in getting in on it. So.
Right. Well, that's okay. We have work courses that will help you identify when you should and when you shouldn't, when you should be buying it and when you should be selling it back to people based on one thing, Mr. Gibson, and that's tying in the core element of the actual fever of the financial crisis. Does that make sense to you?
Yes, it does.
So we would be looking for periods of pullback when people feel that they don't need it. That's when we would be the biggest buyer.
Okay.
And that would be a time series of monitoring. And then setting the right alerts and the kinds of training that you would need on a daily compounded basis, whether it was an hourly update to you directly or it was an hour and a half or hour training session. If you had your schedule ready, then we would address it through that channel. Is that helpful?
That is.
What other question can I answer?
I was going to say I don't want to dominate the time, but I did have one more question if there's time.
Okay. All right, go for it.
Apple. I have been in and out, and I'm just wondering if maybe Apple is getting ready to sell out on us.
I can tell you everything about it. I believe in Mr. Cook. That's one thing I believe in. There is some kind of new case out today that they had a litigation with Samsung. And I believe, and just let me see if I can find out what the real information is, because I don't want to say the wrong thing. So, it looks like, let's see if I can find any news on Apple. As I recall, they may have lost a lawsuit with Samsung. However, that's allegedly that I'm talking about right now until I find out the facts. Okay? So that's one thing of it. There were lots of various order cuts across several of its major. OVTI had reported earnings the other day, okay? And they seen a big drawdown across several of its major handset customers and saw its notebook business decline due to lower demand and the impact from Thailand flooding. But here's the thing. Accelerated competitive pressure is Apple, MMI, SNE, and those companies are all competing. And basically, I believe that Apple is not trading the same as it once did. And it's been on it's got an extremely long-term 2009 monthly rising 10-month moving average. That's multiple years. And it's been that strong that long. Now, when we get down into the core principle, it's all about the shipments. It's all about the new products and the competition. And there are several things that are coming out and being competitive in the pricing control systems of all of these major players, including all the rest of them that you know about in this market. So we are on the verge of this very, very long-term monthly chart on Apple on its 10-month moving average, which is starting to flatten out. And it's got a top that's being put in here and has been over the last 5 months. There's a 5-month topping pattern. From the initial monthly high, 1, 2, 3, 4 months there, and we're testing it on negative volume. Not good. And it is still a very strong company and executes well and will deliver the numbers. However, the problem could be very easily, and we'll be training you on stuff like this, is that it may not be as good as Wall Street wants it to be. Why do I say that? We're going to have some drawdowns even in every company during this financial crisis. You can see right now that growth has come down, but Google and Apple and Google, those two have been doing quite well. So when I look and compare it, Apple, I have to have it compare it to something right now. I compare it to where Google has made the change and Apple has fallen, and that the execution of the company, in my view, as of year to date, with the current analysis that we have, that is a true and accurate analysis that we get our data from. We believe that that is. So what we're saying is that competition is starting to give Apple a little bit of run for its money. And the stock is a little bit out of favor. And there's been a lot of negative sentiment on it as to what the earnings and sales and book ratios are going to be on shipping, receiving. What does the receiving part mean? They couldn't build enough of them. So the supply channels to build their gadgets or their phones and everything, people have a lot of concerns that various components are going to have a decline in sales, including their PC division.
We have 4 minutes left. Time for one more caller.
I hope that answered your question. Call me back or send me an email, info@stockmarketfunding.com. We'll go through the rest of it. So it's not the final answer, but it's the pieces of it. All right, next caller.
Hi, Corey here from New York. Can you hear me?
I can't. Yeah, are you still there?
Yes, I am here, if you can hear me.
All right, I can.
Okay, my question is about the general economy. It looks like we did have an injection of money in the previous year or this year. How does it look for 2012, and how is it different?
What you're talking about stimuluses?
Stimuluses, correct.
Okay. Well, there are
What's
lots
the difference between this year and upcoming 2012?
Well, there will be in 2012 the system itself, the U.S. system versus Europe and other places such as Italy and Greece and Portugal and Spain and just about all of them over there, Ireland and all of them, is that the U.S. banking system in the U.S. component is capitalized well at the moment, in my view, meaning that when the S&P banking system was downgraded last night, I didn't hear them come out and talking about that they weren't running their businesses right in the downgrade, and all these rating agencies are, you know, doing their job now. They're about 10 years too late. But let me tell you about the differences. Worldwide, right now, it's not about us injecting. We're going to have to continue to stimulate our economy totally different. They have to stimulate theirs in Europe versus the U.S. The U.S. is going to maintain their structures using QE3 and other kinds of stimuluses that would help keep growth at a certain rate. Our banks in the U.S. are not nearly in the shape that Europe is in. The catastrophe is that they have to tarp it up with cash. It's got to come from some. And the U.S. versus Europe, Europe needs more than what people are willing to give. The U.S., they're still going to have a surplus of cash injected through the Federal Reserve System. And I hope that answers your question. Send me an email, info@stockmarketfunding.com, and we will cover it in the next segment.
Thank you.
You're welcome. Once again, we talk about worldwide banking systems. We will have many more subjects that we really get down into the core of it and what it really means. It's kind of hard to answer someone right there at the end. But once again, thank you for visiting stockmarketfunding.com. We'll have many, many various different types of workshops. And what are they for? They're for you. And why? Because it will help you manage the risk that you face moving forward between starting 2012 through 2020 at least. Thank you very much. StockMarketFunding.com. Info@StockMarketFunding.com.